just to give you a statistic, the folks in the top 10% of the income distribution, just for context, if you make over 275K a year nationwide, you're in that top 10%. That group accounts for almost half of the spending. So if they're doing okay, the economy can move forward. They'll spend and the economy move forward. But it means the economy is very vulnerable, right? So if anything happens to disturb the financial situation of those folks at the top part of the distribution and they become more cautious and pull back. Yeah, so the fact that the economy is so dependent on the spending done by the folks in the top part of the income distribution means that the economy is very vulnerable to anything that might disrupt that group.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast and YouTube series, Real Estate Market Watch, Current Events Through a Real Estate Lens. My guest today is Mark Zandi, who is the chief economist of Moody's Analytics, where he leads the firm's global research and forecasting. He is a widely cited authority on US macroeconomics, housing, and financial markets, and he advises policymakers, institutional investors, and corporate leaders on the forces shaping the economy. Dr. Zandi has testified before Congress numerous times, is a frequent guest on major news networks, and is the author of several books on financial crises and economic policy. His work focuses on interpreting economic trends, assessing risks, and explaining how fiscal, monetary, and market dynamics affect business and investment decisions. And I am enormously delighted that he joined us. And you are going to hear, in his words, an overview from 50,000 feet of the impact of what's going on or of the economy today. It is one of my holiday specials this year, and I'm sure you are going to enjoy it enormously. If you have not already done so, please subscribe to my newsletter. I do share summaries of these conversations there, and also send out links so you can be sure not to miss any of my future episodes. With that, let's move on. Dr. Mark Zandi, chief economist at Moody's Analytics, coming right up. Mark, what a pleasure to meet you. Thank you so much for joining me today. You asked me how long I wanted to go for before we got started just now. It brings to mind a wedding that I went to many years ago where the father of the bride stood up to say, I have a few short notes that I'd like to talk about my daughter. And he unrolled this this dramatic roll of notes that flood out in front of him. That's a bit how I think today. I've got like 12 pages of 8-font single-spaced questions here for you. But we have limited questions. So I'd like to start at the very top. If you don't mind.
Can I say, Adam, hey, thank you. Did he actually get through that list or?
No, I think it was mostly just theatrical.
Drama. It was drama.
Yeah, it was exactly. Yeah. That's right.
Oh, got it. All
right. So, and I had no intention, no expectation we'll do that today, of course. And so I imagine we might just end up sticking with the first question, but let me open with that.
Yeah, sure.
All right. So you've talked about this long-running structural affordability crisis in America, right? And affordability is kind of a key word at the moment, it seems. Consumers are not just annoyed with prices, they're actually experiencing persistent multi-year squeeze that doesn't seem to be fading. So my question to you is, what are the drivers of this? What are you seeing in this, as far as the affordability crisis in America?
Yeah, and let me say, Adam, hey, just thank you for the opportunity to speak to your audience. I really appreciate the opportunity, and I wish we could. I am an economist; I can speak for 3 days. So, but thank you for the time that you're giving me.
Sure.
Well, I think the affordability squeeze has been long in the making, and really has come back to the top of the kind of discourse and discussion. Collective discourse and discussion because of the reacceleration in inflation that we've observed since the beginning of the year. I mean, obviously prices for many things jumped during the pandemic. did feel like things were settling down. Inflation was going to get back to close to something we'd feel more comfortable with. But at the
Mm,
start of the year, because of the imposition of much higher tariffs and because of the implementation of highly restrictive immigration policy, it's caused inflation to pick up back up, and prices are rising quickly for things that kind of trigger people, like groceries. Buy regularly, and they're key to their happy their dietary happiness, and the prices for that is now up.
mm,
Electricity is kind of the most recent thing, obviously because of what's going on with the demand related to artificial intelligence and data centers. Housing is, and you being in California know this, better than anybody. Housing
mm.
has always been a problem from an affordability perspective, but since the run up in house prices and rents during the pandemic, that's become more of an issue. Healthcare, and that's come to the fore again because of the decision not to renew in Washington, the decision not to renew the healthcare subsidies for the Affordable Care Act, and that's going to affect millions, tens of millions of people, higher insurance premiums. It goes to child care, it goes to elder care. All those things are things that people need, they're necessities, and the prices for those things are up and rising very quickly. And so that's brought affordability back, to kind of the top of the agenda. There's other things going on. I mean, when people think about the affordability issue, they think about their financial system broadly. I mean, excuse me, their financial well-being broadly. And, part of that goes to prices, but also goes to jobs and wages. It goes to, and the job market's struggling now. It's, very difficult for many people to find a new job if they lose one. Unemployment's starting to move higher. It goes to the person's balance sheet. What is it that they own? Many people in the bottom parts of the income distribution don't own much of anything. People in the middle part of the distribution may own a home, but they don't own any stocks. And then it goes to, what do you owe? What is it? What, credit cards, auto loans. And the other thing that's kind of come on recently, adding to the debate and discussion, is the resumption of student loan payments. So, during the pandemic, there was a moratorium on those payments, efforts by the Biden administration to forgive a lot of that debt. That's all over, and now people need to pay on those loans, and that's happened this year. So all these things have kind of been thrown into the pot, come together, go into this affordability crisis and the concerns people have, and it's not going away. It feels like it's here to stay, at least for the foreseeable future.
Right, because it's as you've said, it's not cyclical noise, is it? It's more structural and policy driven.
It feels that way. I mean, and it's idiosyncratic to each of the things that we were talking about. Each thing that we buy has its own kind of story and dynamic, and it doesn't lend itself easily to a policy solution. I mean, the housing situation we need more supply, but what policies can the federal government implement to address that? That's difficult, and will play out over a long. Even if you've come up with solutions, it would take a while, not months, years, for that to come to fruition. So this isn't cyclical. This is more of a structural, as you say, a problem that we all face.
But it's also a K-shaped economy, isn't it? And that seems to be intensifying. Can you talk to that?
Yeah, and the affordability squeeze is obviously
Mm,
most pressing for people in the bottom middle parts of the income distribution. If you're in the top part of the distribution, let's say, just for sake of argument, the top third of the distribution, you're doing okay. You're fine. You have a job. Your wages are rising faster than the rate of inflation. You probably don't owe much of anything. You may have a mortgage loan, but you got that during the teeth of the pandemic, refied into a 2.5, 3.5%
mm,
30-year fixed. And you're right now you're making more on your money market account than the interest you're paying on your mortgage. So why pay it off? You don't have credit card debt. You don't have an auto loan, and you own your home, and you own a lot of stocks. And obviously the stock market's taken off here.
mm.
And so if you own stocks, particularly AI stocks, which many of these folks do, then you're sitting in a pretty good spot. If you're in the middle part of the distribution, like the middle third, life is okay. There's pressures. You probably don't own a lot of the stocks. You own a home in all likelihood, so that's good, but you don't own much in the way of stocks. You're not benefiting from this run up in the equity market. You have a job, but you're nervous because if you lose your job, it's going to be very difficult to find another. Nobody's hiring. The hiring rate is, very low, and people sense that. And then if you're in the bottom third of the distribution, it's tough. You're the struggling with the higher prices for these necessities. These necessities make up a larger share of your budget than for folks in the top and middle parts of the distribution. You don't own anything. You don't own a home. You don't own stocks, and you owe a lot. You owe on your credit cards, and you probably owe on an auto loan. You may have student loans, and so you're shelling out a lot of your income each month on just servicing the debt that you have. And so that's the K-shaped. These groups are moving in different directions. And that's a big part of the affordability crisis. It's really the folks in the middle and bottom third of the distribution that are feeling the biggest squeeze from the affordability problems.
And so what are the implications of this for the economy overall, do you think? And what is it, how do we learn from this? What lessons do we get from this in terms of understanding what's going on?
Well, there's near and longer term implications. I mean, near term, it means the economies, can move forward because the folks in the top part of the distribution are spending, they're doing their thing, they're in good shape, and they're key to the overall economy. I mean, just to give you a statistic, the folks in the top 10% of the income distribution, just for context, if you make over 275K a year nationwide, you're in that top 10%. I know that doesn't sound right if you're sitting in California, but it sounds like really a lot of money if you're sitting in Des Moines. But if you make over 275K a year, you're in the top 10%. That group accounts for almost half of the spending. So if they're doing okay, the economy can move forward. They'll spend and the economy move forward. But it means the economy is very vulnerable, right? So if anything happens to disturb the financial situation of those folks at the top part of the distribution and they become more cautious and pull back. Yeah, so the fact that the economy is so dependent on the spending done by the folks in the top part of the income distribution means that the economy is very vulnerable to anything that might disrupt that group's spending. So, for example, they've benefited enormously from the run-up in stock prices, and if the stock market were to stumble, if for whatever reason we saw a major correction in equity prices, and you could easily construct that scenario given valuations in the market, that that group would take it on the chin. Not that they would cut spending because they have all kinds of financial resources, but they would become more cautious. If they become more cautious, you combine that with the troubles of the folks in the bottom two-thirds of the distribution, that's the fodder for a much weaker economy and potentially even a recession. So that's short term. Longer term, it can't be good, I don't think, if the economy is so dependent on the well-to-do, the very well-to-do. I mean, I think that leads to all kinds of societal issues and in many respects, the political fracturing that the nation has suffered in recent decades. Because this K-shaped economy has been forming for not just the past few years, it's been forming for the past few decades. And so therefore, I think it makes it very difficult for us to find a consensus as a nation because we're all running on different kind of dynamics. We view the economy very differently. We have different perspectives on what the appropriate policies are. Then we can't address and ultimately solve some problems, big problems that we face. Everything from what should we do about Social Security, Medicare, Medicaid, to what should we do about climate change? So, the longer term consequences of this K-shaped economy are quite pernicious, I think.
Is this something you've seen before in your career?
Well, this has been long in the making. Yeah, the skewing of the income and wealth distribution. The description of it being the K-shaped economy, that's new. That's been in the most recent period post-pandemic, but really the skewing of the distribution has been ongoing since the early 80s. Lots of different reasons for that. So it's
Mm.
not something that is new. It ebbs and it flows. I mean, typically what happens is when the economy is in aggregate in recession or struggling, we kind of forget about the income and wealth distribution because we're all kind of suffering together.
Mm.
But when the economy is expanding and growing, then that's when these issues kind of reappear in kind of the public discourse, and that's what we're observing right now. I will say it feels like it's taken on a more central role in our thinking, since post-pandemic, and I think that's because the skewing has accelerated, largely because of wealth and largely because of what's going on in the stock market and who owns the stocks.
Yeah. And yeah, I mean, there's some really obvious examples of this. And, I think you had a conversation with Dalip Singh, who referred back to the late 19th century. Actually, my PhD actually looked at
Oh,
the Gilded Age and banking in the early 20th century. This was actually at a time when income tax was considered unconstitutional. There's no income tax
yeah,
in those days.
yeah.
So what? So you've talked about this upper band, this 10% that's really driving the economy, or the upper 30% really driving the economy. Oh, I know what I was going to say was, you
Yeah.
look at examples. Well, the reason I mentioned the
Uh-huh.
20th century, the Gilded Age,
Yeah.
you look
Uh-huh.
at bonuses, $1 trillion pay packets. I mean,
Yeah.
it's just mind blowing, isn't it? Really, when you think about the the gap that there is in America.
Oh,
How do you
yeah.
react to that? I mean, how do you interpret it? It's just mind blowing. It's even more, it's even more bizarre when you think of it compared to the Gilded
Right.
Age. It just seems like the gap is
Out of bounds.
stratospherically different.
Yeah. Well, it goes to kind of like the winner take all economy. I mean,
Mm,
because the winners have uh, significant control over, the technologies in this case that in the
mm,
case of the $1 trillion payout to Elon Musk
mm,
that are kind of key to everyone's standard of living and growth going forward. I mean, in some, I have mixed emotions. I mean, it does feel out of bounds and extraordinary that such a few number of people are enjoying such wealth compared to everybody else. But having said that, yeah, if you take Elon Musk as your case study, they're
mm,
driving a lot of value, right? I mean, he's not going to get that trillion. I don't know the pay package and the terms that well, but my cursory understanding is he's not going to get $1 trillion unless he generates a ton of wealth, meaning he's going to invent more new things that are going to make all our lives better. So, and that is one distinguishing feature of the U.S. economy compared to others on the planet. And that
mm,
is, if you do create value, if you are entrepreneurial and you start companies and you come up with new products and services and you make everyone's life better, you are a huge beneficiary. You benefit from that, and it incents people to go out and be entrepreneurs. We revere in the United States entrepreneurship. We put those folks that are advancing the technological ball on a pedestal, and I think that's a good thing. But having said that, you're left with this incredible amount of wealth that's being concentrated in the hands of very few people, and they gives them a lot of control and power, and that creates its own kind of problem. So it's a very difficult issue. I will say I do think it does make sense that we view or think about every policy that we implement through the prism of what it means for the income and wealth distribution. Think about all the different criteria one would use to try to decide, is that a good policy or is that a policy we don't want to implement? And all policies have winners and losers. So it's just by definition, that's the case. And you have to balance those things and you decide which policies you want because they benefit more people than they hurt. I think we should probably formalize in some way thinking about how policies that we implement will impact the income and wealth distribution and use that as a criteria for deciding what policies to implement, which policies not to implement, and how to implement them. But we kind of sort of do that in the political debate, but we're not very formal about it. So like the Congressional Budget Office, CBO, is the formal budget keeper of the federal government. They evaluate the economic and fiscal impacts of all these policies. And sometimes they think about the distributional effects, but I think they should bring that as part of their process. So every piece of legislation that's being considered we think about what it means for the income and wealth distribution, because that's going to become, much more of an issue. It's a big issue now. It's going to become more of an issue going forward. And it does potentially have serious consequences, both short and long term.
So what's the term, Mark? It's exorbitant privilege, isn't it?
Exorbitant privilege.
Right. So you hold up the American economy as being strong enough to sustain this kind of K-shaped, growth, if you like. And exorbitant privilege lies at the core of that. So are there any structural policy threats, do you think, to the US economy that could counter that assumption?
Oh, sure. Many. I worry about that quite a bit. I mean, in the current environment, broadly, between World War II and the end of the Obama administration, the U.S. economy and the global economy were quickly integrating. It was a period of rapid globalization. And again, there were winners and there were losers, but the net of all of that was a big victory for the global economy. It lifted hundreds of millions, if not billions, of people out of poverty or close to near poverty. And it was a net positive for the U.S. economy as well, and for U.S. consumers. Again, there were losers, folks that lost out because they worked in manufacturing facilities in the middle part of the country and were lost out to the cheaper competition from China. But net, it was a very significant positive. And it was a world where you mentioned Dalip Singh. He's the
PGIM.
Yeah, PGIM, the vice chair and global chief economist. He was on my podcast. He was making the point that that was a period when it was what he called a unipolar world, where the U.S. was in the middle of it all, and that goes to the exorbitant privilege. We benefited enormously from being central to the global financial system and economy. But since the end of the Obama administration and since the decision by President Trump in his first term. In fact, I think it was one of his first executive orders to back out of the Trans-Pacific Partnership. That was the free trade deal the U.S. was entering into with the rest of the Pacific Rim that excluded China because they didn't play fair and they couldn't get in until they did. But that was the beginning of the end of globalization and the start of this process of deglobalization, which is happening in full swing. Tariffs and immigration policy, sanctions, export controls, investment restrictions, fees on visas. I can go on, travel, tourism, so forth and so on. We are now rapidly deglobalizing, and as a result, the U.S. is quickly going to lose its place as the kind of center of gravity in the global economy. That unipolar world is devolving, and the result will be a much diminished economy. So that is just one example of the kind of things that we're potentially could be a very serious impediment to that exorbitant privilege that you talk about.
Let's get back to that the deglobalization in a minute. I just want to ask you though, do you think that the effect of that and what's going on in the economy is creating a new Gilded Age in America?
Well, there's a lot of similarities.
And what are the implications? Similarities. What are the implications as well, if that's the case?
Well, the implications we were talking about, short term, makes the economy quite vulnerable. Long run, it creates problems from a societal perspective, and is the basis for the political fracturing. The way we got out of the Gilded Age, or the way how that ended, was somewhat disconcerting. It really wasn't until the World War I and World War II that kind of disrupted all of that.
With a depression in the middle of it.
I forgot about that. Yeah, right. That little thing. We made some attempts.
Mm,
There was antitrust, towards the early 1900s in an effort to kind of break up the concentration of wealth and power. So there was some recognition that this was an issue and that we needed to do something, that the nation needed to do something about it. But at the end of the day, I don't think it really got upended completely until World War One. And going back to Dilip, he was making the
mm.
point that that's a scenario that's not his baseline scenario, but that's a scenario that this all leads to some kind of conflagration globally that upends things. I'm not that pessimistic. I think we will be able to navigate through and we'll figure it out. And there's the pendulum politically is going to swing back and forth here. I think we'll see. Obviously, what happens here in the next year or two. But I think we'll make an effort at it. But the lesson is a very sobering one. If we don't address it ourselves, it may end up being addressed for us in some very uncomfortable way in terms of a military kind of a military event.
Okay, so that actually was where I was going to head. So because of a big fundamental difference between now and the First and Second World Wars, this idea of mutually assured destruction, right? And so the weapons that are used these days are not necessarily military, are they? They're more economic. How do you see that evolving and influencing the world today in a different way than it has done before?
Well, this is part of the deglobalization. It's a result of the deglobalization and it's a cause of the deglobalization. It's reinforcing the deglobalization. And I mentioned things like sanctions and export controls. There's all this debate over whether NVIDIA should be able to export its chip to China, its high-end chips to China, its AI chips to China. It goes to investment restrictions, the restrictions on H-1B, on migration. All these things are in full swing, and that means that we are pulling away quickly from the rest of the world, and that will put pressure on the that exorbitant privilege, the ability of our the things like the safe haven status of the United States. I mean, in a unipolar world, because we were kind of in the center of it all, if things started to go bad anywhere on the planet, including here in the U.S., money would come flowing into the U.S. It
Mm.
was a safe place to go. It was the AAA credit. It was money good if you put your money here. It's we haven't lost that. I mean, it's still the case that we're the safest safe haven on the planet, but that's certainly been diminished, and that will continue to be diminished as we continue to deglobalize. But going back to the economic statecraft,
Mm.
that is part of this deglobalization process. That is a result of it, and also that statecraft will reinforce the deglobalization that's occurring. We're going to use that statecraft. And by the way, we're not alone in using it. Our biggest partners are, fully engaged in that as well. The Chinese, we saw in this most recent battle over tariffs, the Chinese came back and said, well, if you're going to not let me have those chips, I'm not going to let you have my critical minerals, which you need to produce tech products. So they're doing the same thing. And so is increasingly everyone else on the planet, including our allies, because they're beginning to wonder, how reliable are we as a partner and as an ally? The Europeans, the Canadians, the Mexicans, the Japanese, are going down the same path. So, and that does lead to conflict and tension, and goes back to, that the point that maybe this all ends in some kind of military event because the tensions that will just boil over, going from economic kind of battles to something more serious than that. I do, get your point about mutually assured destruction. Maybe, that limits our ability militarily to get into real trouble, but I'm not sure it stops us from getting into trouble militarily.
Well, no, we see what's happening with Venezuela and
Yeah,
elsewhere as well,
there you go. There you
cooking
go.
along,
Yeah,
so we should be totally focused on the US economy, but yet
yeah.
we have these strange distractions. So you talked about also that there were scenarios that could topple the top 30% in the economy, the top 10%, and talked about you could construct a scenario where that does splinter. How would you construct it then in real terms based on what you're seeing in the economy today? What do you think are the
Well,
kind of the likely scenarios, possible
yeah,
scenarios?
yeah, my mind immediately goes to the stock market.
Mm,
A lot of wealth has been generated there, and that's key to all the spending we're getting by the well-to-do. I mean, just to give you a statistic, the total value of publicly traded stock in the U.S. is up over $10 trillion in the past year. I'm making this up, but roughly speaking, if you go back a year ago, the value of all publicly traded stock was 57, $58 trillion. We're now at 67, 68 trillion. And
mm,
that the ownership of that is very narrow, a small group of
mm,
people. And that is all AI, or the vast majority of that is artificial intelligence companies. Their equity valuations have risen
mm,
rapidly. And, I do think you can argue reasonably that the market, the AI stocks, and more specifically, are overvalued, bordering on frothy. Certainly by any tried and true measure of valuation. I mean, my favorite is just to
mm,
take a look at the value of publicly traded stock and divide by after-tax corporate earnings, kind of a economy-wide price earnings
mm.
multiple. And if you look at that I've got data back to 1960, the average multiple is 12. The current
Today,
multiple is 20, more than two standard deviations away from the average. And it's the highest it's ever been, save for in the teeth of the Y2K bubble back in 2000.
right?
It got to 24, so this can run for longer. But it does feel that valuations are quite high. And fundamentally, what I think investors are really banking on AI being this rapidly evolving, game-changing kind of technology that will be adopted quickly, will affect and impact the business workflows quickly, lift productivity and lift profitability and pay off. And, that definitely could be right. But I
Mm,
think this is the alternative scenario that the investors, are right in that AI is going to lift productivity. It is going to be a big deal. It is even a game-changing kind of innovation, but not to the degree that they expect. Certainly not as fast as they expect. That the adoption rates just aren't going to be as quick. That it's hard to adopt these new technologies.
mm,
And in fact, historically, if you look at other game-changing technologies like the internet or electricity or railroads, it took time for that to diffuse, and the technology didn't really diffuse until you had new companies form and optimize around the new technology. That existing legacy companies really have all kinds of difficulty implementing the technology for lots of different reasons. Don't have the
mm,
right people, aren't organized properly to take advantage. There's all kinds of legal issues, regulatory issues,
mm,
concerns about cannibalization of existing products, a lot of different stuff going on. And if that's the case, if history is a reasonable guide and AI takes time to be adopted and to be implemented in workflows and to have impact productivity, then you could, at that point, one could conclude that the investors are wrong, that they're overly optimistic. You see a correction in equity prices. Prices go back down, kind of like Y2K, and that knocks the wind out of the well-to-do, the folks that are driving the train, and you have a problem. And that's the scenario
mm.
that I would worry about.
I love that you used that analogy, the train, because that is also it's the railroads as well. So
The
that was also
railroads,
kind
yeah,
of the as well, I
yeah.
think. The thought that I have in response to that is this idea that the pioneers are the ones that take the arrows, right? They're the ones that forge the future, but it's the ones that come in their wake that are ones that, that really succeed. And so if that is if I can use that analogy,
Yeah.
then does that speak to really a fundamental challenge for the economy if our pioneers who are driving the economy at the extent that they are today are the ones who do actually, I don't want to use the word fail, but
Yeah.
do give way, but it takes time for that to happen.
Yeah, I hadn't thought of it that way, but I think that's a really insightful kind of way of thinking about it, right? Because you usually, at least in my limited experience, you don't want to be the first to adopt a technology. You kind of sort of want someone else to take it, start and take the arrow, and you learn
Right.
from that, and then you benefit from that. So the
Hmm.
folks that are kind of on the front line here, pay a price. In the case of AI, maybe that's the wrong way of approaching it, just because a lot depends on scale, and getting to scale very quickly. So if you're slow to get into the game, you'll never get into the game. So that could
Hmm.
be the case, and that's what investors are saying is happening here. That kind of is the dynamic they expect. And again, I don't know. That seems like a reasonable possibility, but I do think there's also a reasonable probability that that's not quite right. And this is going to be more like other technologies. It's going to take a while for it to really be used effectively. And if that's the case, then buckle up. We're going to have a correction here, and that
Right.
could take out the economy under certain circumstances.
Right, which of course does beg the question, is this time different? But I'm going to ask
Yeah.
it in a
Yeah. There
different
you
way.
go. Yeah.
Right, this time is different. Taking that idea, in what way is the economy, do you think, or this AI boom driving, so important as it is to driving the economy today? In what way is it different, do you think, from the dot-com bust and the emergence of the internet?
Well, there's good and there's bad. I mean, I remember that the Y2K period quite well, and it does feel like in that period there were a lot of companies that formed publicly traded companies that really were built on not much of anything.
Mhm.
It was the poster child would be the pets.com.
Right. Hmm.
And I think that's a pretty good description of a lot of the companies. I don't sense that here, at least not so far. I mean, these
Okay,
companies,
but why? Okay, why is that? Why is that? Why is it different?
well, I mean, there are fewer of them. I mean, back then there was a proliferation. I mean, you take me for an example. I had my own, before I became part of Moody's, I started my own company back in 1990.
Economy.com, right? And you get
Well, in 1990, there was no
there
dot
was
com.
no. That's right. That's right. That's right.
So it was Regional Financial Associates. Then it came Y2K and the internet boom. I went out and bought the URL economy.com and we became economy.com.
Mm,
Our company was no different the day after I bought that URL than I was before the day I bought that URL. But,
mm,
I bought the .com. So that's kind of a metaphor for that period. There were real
mm,
companies, but there were also a lot of other companies that were just piggybacking off of
mm,
the momentum and the euphoria and the craze. Doesn't feel like we're in the same place here. At
mm,
least not yet. Now that where this is a script being written, and this may be early. We could be 1997. So in 1997 it was still real, but by 2000 it wasn't. So we could still be 1997. We got another couple 3 years to go before this thing, goes in an untoward direction. But that to me that's a big difference, between then and now. It's just the companies that are forming now and that are at the center of the equity boom. They're real companies. They're real companies.
well, that's the.
The other thing I'd say is adoption and demand. I mean, if you go back to Y2K, the telecom companies, they were the big hyperscalers and they were investing very aggressively in the internet infrastructure and backbone.
Mhm.
But it took a long time for that back in infrastructure to be used. I mean, the utilization rates were very low for an extended period. So these telecom companies invested a lot, but didn't get much of a return for quite some time. And therefore you saw failure of these big telecom companies. that doesn't feel like what's happening here, at least not at this point in time. The adoption rates are consequential. People are adopting quickly. Demand is strong. So if that remains the case and adoption rates don't level off, people don't become discouraged because they can't figure out how to bring AI into their workflows. If that doesn't happen and demand continues to improve, then, that's a big difference between now and then. The other big difference, though, and this is more of a negative than a positive.
Mm.
Back in the Y2K period, it felt much more equity driven than debt driven. There was borrowing.
Exactly.
There wasn't a lot of, I mean, I know I have really good bond issuance data. I could tell you exactly what, these companies were issuing. And the amount of bond issuance going on back then compared to now in today's dollars is very different. Today, these guys are issuing a lot of debt. They're taking on a lot of leverage to finance the build out. That wasn't the case back then. Therefore, when the equity market blew up in Y2K, it didn't take out the financial system. It was just the equity holders that got hit. And so it hurt the economy, but it didn't crush the economy. This go around, if leverage continues to mount, then, if there is a problem and demand doesn't materialize as expected, and we see defaults on that debt, and it will affect the financial system and the economy will suffer more. So there's a lot of similarities, but there's also a lot of differences. A lot of good differences between now and then, but also some cautionary differences between now and then.
Well, that was exactly the direction I was going to go in, is this question of debt. I mean, one of the big differences today, of course, is that the companies that are powering AI growth, oh my goodness, it's already 40. I can't believe it's not to the time. Good God. Told you, we're still on question one.
It's a great question. I can chat.
Oh, goodness. I was afraid to look at the time, actually, because I thought maybe only 10 minutes has gone and I won't know how to sustain this. But we're almost at the top. All right. So let me just wrap up with one question, and then actually two. I'm going to just finish up this line.
Okay. Yeah.
And then I'll go to one final question.
Okay. Right.
Okay, so one of the big differences, the power of these companies today that are driving the economy is fundamentally different because they are enormously profitable companies, like mind-bogglingly profitable as they drive and invest in this. But as you say, there's also a huge amount of debt being taken on, which is fundamentally different from the way it was in the Y2K era. Is that debt, if that bubble does burst, is that systemic, do you think?
Well, I don't think at this point I would characterize it as systemic. I don't think the leverage is large enough, dispersed enough, and opaque enough to take out the system. But it's the direction of travel that concerns me. I mean, the amount of increase in leverage in the last few months, certainly in the last half of 2025, has been extraordinary. The amount of bond issuance that's been done in the fourth quarter of 2025 and still not over. We're still here in mid-December, is a record high for tech companies going all the way back, prior to Y2K. So if that continues, then yeah, I think this becomes more of an issue, and it is becoming more opaque and more creative in terms of the financial engineering that's going on. It is all the ingredients to suggest that this might be more of a financial system problem are coming into place. Not there yet, and we'll see how this plays out. But if you ask me back, Adam, a year from now, and what's happened in the last 6 months has happened for the next year, I might be sending off. Right now, I might send off some yellow flares, but I would be sending off some red flares at that point.
All right. So let's wrap up with one final question. One of your podcasts, you talked about being schizophrenic about the markets. One of my favorite films, actually, is with The Who. It's Quadrophenia, where he talks about being quadrophenic, having 4 different personalities. But he talks about being schizophrenic about the market. So being an economist, I know you love to make predictions. Going into 2026, cause for optimism, gloom, or in general, how do you think investors should be positioning themselves today going into 26?
Well, for most investors, I think you just stay the course, right? I mean, is this Warren Buffett who says something to the effect, "Don't bet against the American economy"? I mean, in the long
Yeah, but
run.
he's retiring and going to
Yeah, he
cash.
is, but he
Don't
did
forget
quite
that.
well. He did quite well, Adam. I think I think that's a good lesson for most people. Just don't even look, stay the course. Just, do the fundamentals, meaning, you want to make sure that what you're invested in is consistent with your risk profile and your horizon. My horizon is very different than my son's horizon. I'm not going to go be plunking down cash and core weave, but not a bad idea if he does. So, so you got to take all those things into consideration. But at the end of the day, there's going to be up, there's going to be downs, there's going to be all arounds. But if we look back, when we look back 10 years from now, I'm still quite confident the American economy will prevail. That, investing in the U.S. economy is always a winning bet in the long run.
Dr. Zandi, Chief Economist at Moody's Analytics. What an enormous privilege and pleasure to have you on the show. Thanks for joining me.
Oh, you're the best. Thanks for those great questions. They were pretty far ranging, and I got to go to the usually I'm at the 10,000 foot level. You let me go to the 50,000 foot level, so that's great. Thank you so much.
Sure. Well, maybe next time we'll go down to the 10-foot level. I don't know.
Yeah, there you go.
Thanks for having me.
If I go to the street level, I run out of oxygen. So thank you.
All right, that was Dr. Mark Zandi, Chief Economist at Moody's Analytics. Mark, what a pleasure to meet you. Thanks so much for joining me. I'm incredibly flattered that you did join me. And I really enjoyed our conversation very much indeed. I'm quite serious about perhaps revisiting next year just to see where we are. This time next year, it would be very interesting to see how the economy is developing, hopefully in the right direction. Anyway, thanks for joining me. Really appreciate it. And thank you too, dear viewers and listeners. Thanks for sharing today's episode. I hope you found it interesting. And, I just discovered something. This podcast is published on YouTube, but it's also available on Amazon. Can you believe that? Just look up my name, Adam Gower. You'll see a bunch of my books there. Leaders of the Crowd is one. Jacob Schiff and the Art of Risk is another. Click on my name and scroll down the page, the author page, and you'll see the podcast there on Amazon. Oh my goodness. So available on podcasts everywhere and on Amazon. All right. I appear to have really reached the pinnacle there. Okay, that's it. I hope you have a happy holiday and look forward to seeing you again in 2026. But for this week and for this year, thanks for joining me. And until next time, this is Adam Gower signing off.